Hi guys, I'm George Karani, and today's session we really have a cool guest who is going to dive deep into the world of venture capital. You really won't want to miss this one. So, welcome, Alex. Please give us a brief intro about.
Hey George, thanks for having me.
Hi.
Brief intro. So, I have a college degree in engineering. I studied electrical and mechanical engineering. I started my first company when I was 22 after I worked for some companies in industry like Tesla Motors, iRobot, which makes those like robot vacuum cleaners. And I worked for a liquid metal battery company for a little while, which was really interesting. Got the entrepreneurial bug, decided to build a company. When I was younger, we were building software and hardware devices for construction sites. So the best analogy I can give you is like Nest thermostats, those like smart thermostats and smart sensors, very similar to those. We measured temperature, humidity, light, noise, vibration, dust, basically anything that would cause an issue on a job site. Big commercial construction was primarily our customer base. And then I ran that for about 8 years. Sold that in April of 22 or 21. I forget. Anyway, it was like 21 or 22. And then I was recently on a sabbatical for the last 2 years. But during that period of time, I've been working in venture capital. So I have a bit of background on both sides both sides of the table, as we say. On my entrepreneurial side, I've raised about $8 million over 4 funding rounds. And on the VC side, I've been working for 1517 for about 3 years. So I've have a bit of experience in both, which I think is relatively unique. It's certainly interesting to have both sides of the experience. So happy to be here with you. Hope that helps.
Yeah, it's really cool to learn from your journey as a founder to now part of the VC team. So, what sparked your interest to venture capital?
I wish I had some amazing grand story to tell you, but to be honest, it was kind of an accident. The fund I work for has a role called advisors in residence. And so what we are is effectively founders who have been through hell and have come out the other side with, I guess you could say like what not to do, or as one of my mentors
Yeah,
used to say, trying to help people make different mistakes rather than the same mistakes that everybody makes.
yeah.
And that was the beginning of my work with the fund I work for now. And then recently they invited me to become a part of the team in a more full-time capacity. So it seems like it was just a natural evolution. I wish there's no like magic story, it's just kind of like it was the next best thing.
So your thesis at 1517 Fund is basically funding founders without like traditional degrees and educational background. What trends are you most interested in within our industries with these founders?
Yeah. So I want to step back and just say, like, one of the unique things about us or what we're doing is this idea that if you want to change a system, and everything is systems, society is a system, economies are systems, right? If you really want to change a system, you kind of have to get outside of the system. And
Yeah,
we've just found that people who are not formally trained or educated have a pretty unique perspective. And it has nothing to do with intelligence, right? Like it just really depends on whether you have either the financial, the money to go to university, um, or the time, and sometimes some of the smartest folks that we've run into, don't or haven't, they just have moved right into what they want to work on. And we've also noticed, and I think this is changing now, but we've also noticed that, in venture capital and finance, there's tends to be a bit of a bias around funding people who are credentialed, right? Who have the so
yeah,
to say pedigree, the document. They've been to the institution, right? They're rubber stamped by society, and it's difficult if you're one of those folks who doesn't have that stamp to find investment. And so that's really where I think we're trying to be different. With regards to how we think about our investments, we're primarily focused in the business to business world. We have a deep tech requirement, and I'll define that real quick. So deep tech is basically like some type of unique and non-trivial technical moat. So there's technical insight that someone will have, a founder will have, that is significant. We're not marketplace investors. We don't really do deals in SaaS, that sort of optimization, aggregation, things like that. We're more focused on unique and compelling innovations. And that can be software, but it tends to be a lot of hardware. And we're doing a lot of biotech as well right now.
So I think that's really interesting. I've also met some of the smartest people who are also building really cool stuff for niche kind of communities and niche kind of markets. I think that's something really cool that 15, 20. What's the toughest decision you have ever made as a founder that now you reflect on as part of the DC?
I mean, as a founder, the toughest challenge I think I had was really two things. I guess they're very similar. One was I had to fire my co-founder. So, that was emotionally very challenging. We were also living together. We were very close friends. And it was, business and life were kind of intertwined, if you will. And that
Yeah.
was difficult. That was really difficult. But I think the second thing was getting my company through COVID. So we had just raised about $4 million, and then a year had passed, and then COVID happened. I think the first case that was sort of officially reported in the U.S. was like a block from my office. I was in New York at the time, and so shut the office down. Everybody goes home. We were an in-person team. We all of a sudden had to figure out how to be like an out-of-office team. Then we had a bunch of our customers who were struggling, and we lost a bunch of accounts because people couldn't pay. Construction got shut down in the U.S. pretty significantly, and all the while we're trying to find an acquirer for the business. It was like, revenue's not great, companies, in turmoil because people are trying to figure out how to work together remotely, and then all of a sudden you're trying to sell the business. And it was really tough. So, you get through it. But the best way I know how now is just one foot in front of the other. There's days you're not sure what's going to happen, but yeah, one foot in front of the other, one day at a time. That's how you get through the hard times, I think.
So I guess what now surprised you the most when you joined the VC world that you didn't expect now as a former founder?
Yeah, that's a great question. The first thing that comes to my mind is that I didn't appreciate how some businesses that are actually good businesses don't fit the VC model. And what I mean by that is, in the startup world, I think there's so much talk of, the way to raise money is through a venture capital firm, and you want to raise VC money, and it's kind of like all people talk about. I think there's not really much known about other alternative forms of capital. But the challenge with VC is that, let me just give you like the basic fund economics. So we have $100 million fund. That means that we need to, in order to be a top 10% firm, we need to 4x people's money in 10 years. So that's the math, right? So how do we do that? Well, we have to invest in businesses that we think can get the scale to actually return $400 million, right? And so when you think about like the economics of a business, some businesses, they'll never get there. It's not because they're a bad business. It's because the fundamental mechanics of the business, it could be the size of the market they're going after, the scalability of the product, the offering, is it niche or not? They just won't get there. And I think that's the challenge for founders in thinking about not just like raising money, but what type of money to raise is something that often goes overlooked. It's oftentimes there's no thought between, hey, we need to raise money, let's go talk to VCs, right? And I think what I want to make people aware of is that VC is a very specific type of funding. And it's a specific type of funding that has very specific types of requirements around what that business's potential needs to look like. And the challenge with founders is oftentimes you may not hear that from people you're speaking to. You may not hear that from investors. Like, I'm trying to be as honest as possible because, quite frankly, I had so many pitch meetings where I just got crap feedback and didn't know how to make myself better or make my pitch better, or if I was even talking to the right people. And so I think as a founder, you really want to consider, like, is this business going to be a business that could theoretically achieve a billion plus, ideally more, right, for the VC model in valuation or exit potential? And if so, VC is probably the right idea. It's probably the move. We can talk about other forms of capital if you want, but I'll stop there. It's just something that's like so obvious, but I don't think a lot of people talk about enough, specifically around funding businesses. And you can waste a lot of time talking to the wrong investors. And if, as an entrepreneur, time is money. You need to keep the lights on, and you need to do that through progress. And so it's it's something that I think people should think deeply about before they figure out a funding strategy.
So I think most startups usually, most of the products usually take some time before they usually have that takeoff into the market that they are going into. So what do you think as VCs about early on, valuations for companies at their early stage?
Yeah. This is this is where I'll say it's an art, not a science. So I think there's a couple really important variables to consider. I'm going to put my founder hat on, and then I'm going to put my VC hat on, right? So I'll speak as a founder first. As a founder, I think it's really important to be optimizing for long-term ownership. And what I mean by that is, you, as somebody that's gone through pretty significant dilution, you lose a lot of motivation, if you don't own enough of your business in the later stage. And I think the protection there is balancing, in the early days, balancing the amount of money that you think you need versus the dilution that you're going to take on. So what does that mean? That basically looks like, hey, I did the math, and like my perfect world would be, I'm going to raise $1 million. Like that would be amazing. I would have everything I needed. I'd be able to make all the hires I want, and that's all good, right? But depending on the traction that I have, that $1 million may be incredibly risky for an investor. I haven't de-risked the business model. I don't know how I can really make money reliably here. Maybe there's a core technical innovation that's not solved or perfect yet. And so what I would advise, or typically what I do advise founders, is like, look, let's say you're going to raise $1 million, but you're going to take on, 10 to 15% dilution right out of the gate, right? And if that's the first money you're raising, that can be significant, especially if you have other co-founders. And then I want you also to think about, every round you do, you're going to sell between 15 to 20% of the company after that. So very quickly, in 3 rounds, pre-seed, friends and family angels, and then pre-seed and seed, you're looking at maybe 40% dilution, right?
Yeah.
And so it adds up, it stacks pretty quickly. And so typically I would be like, look, can you take 500 and can you get far enough along where you've unlocked something critical to the business, whether it's solving that technical problem or basically making sure that you've figured out how to make money, right? Getting the revenue flywheel going, such that as a new investor, I'm coming in and saying, hey, I'd rather give you a premium. I'd rather give you a better valuation. And then that's less dilution for the founder. Because as investors, we're always managing risk versus the invested capital. So I'm gonna put my VC hat on.
Yeah.
So depending on what type of investor we are, whether we're early stage, later stage, if we can write checks, like like for example, at 15, 17, we're investing all the way from 100,000 to $2 million, which is a nice wide range. And so that means what we'd rather do is we'd rather give you a smaller amount of money. We'd rather you hit it out of the park, and then we'd rather follow up with a larger check, because now we've watched you execute. We've watched you deliver on the promises you're going to make. And now we're more confident that we call it backing up the truck. Right? It's like, imagine the money dump truck, and we're like, hey, just back it up, right?
Yeah.
And that's the thing that I think most investors want is, I like the team. I like the product. I think it's a great product, but there's just some things about the business that aren't making me feel great. I'm just concerned, right? And
Yes.
so if you can break out those milestones and raise cash that addresses those milestones and be storytelling, I mean, this is a key part we can talk about if you want, but a lot of founders don't do a great job of telling the story of how they're solving these problems in a way that makes investors feel good. I'm happy to write you another check. I want to write another check, but I don't necessarily want to give a new founder, a first time founder, 1 million bucks at the idea
Yeah.
phase or maybe pre-revenue and say, go have fun. I'd much
Yeah.
prefer to say, hey, take 500 and show me what you can do because we have another million sitting over here for you if you execute well, right? Now, maybe that's
Yeah.
specific to us, maybe it's not, but that also protects founder dilution because recently we had a founder who was pretty significantly diluted, and one of their Series A investors found out about that and actually pulled the term sheet from them because of the cap table. So yeah, it can be tough.
Yes. So I'm going to follow up that with a really cool question. What from now, like your experience at 1517 fund, which has been your most interesting investment?
Most interesting investment, personally or as a fund?
You can do both.
Okay, let's see. I think so as a fund, and I'm just going to caveat, I wasn't here for this one, but what we talk a lot about is this company called Stark Therapeutics. And Stark Therapeutics is basically a guy in a basement who's working to cure type 2 diabetes. And if you know the American health system, it's kind of a mess and we're all kind of sick, and diabetes is a real problem. So that's
Yeah.
pretty exciting. I mean, this is like total classic, you know, 15, 17, where it's like guy in basement, no college degree, crazy idea, over the last, I don't know, 6 years or so. We've been working with him and he's doing quite well. And I think you're going to see some really exciting things from that company soon. Personally, we did a deal like this is what is near and dear to my heart as a technologist. We did a deal in a company called Pascal Tags, and Pascal Tags is basically making a replacement barcode that doesn't require line of sight. So they basically use a wireless signal and they get a reflection back from that tag, and so you can scan things basically without seeing them. A box rolls by on a conveyor belt and you can tell exactly what's in the box. You don't need to open the box. And so when you think about applications, it's everything from, food and beverage to manufacturing, supply chain, UPS, airline. Like honestly, the use cases are staggering. And I've had the fortune of working with them for a few years now, and yeah, it's really exciting. I think it's going to be a really interesting company if they can start scaling.
And I think like now, like as a technologist in venture capital, um, there's this trend going on right now of AI. So how are you seeing AI?
Yeah, that's I think that's the $1 billion question, right?
Yeah.
I'll be honest with you. We are not doing a lot of direct AI investments. I think there's so much similarity to what's happening now in AI to the .com, boom bust cycle.
Yeah.
We're not a large fund. I mean, $100 million sounds like a lot, but in the grand scheme of things, it's not a lot. It's a small to medium size, I'd say. And we just don't have the capacity to make bets in that space with all the hype and all the valuations are crazy. I mean, people are getting very large valuations, and it's not really clear if there's a value proposition that's going to support it. And so we're looking at businesses that are more AI enabled rather than straight AI plays, models, efficiencies, things like that. We're looking at more like businesses that are accelerated or supported by AI, not necessarily like AI and offering an AI offering is the core product. We have done some of those deals where we have a pretty high degree of conviction or we like the founder, like we've known them for a while and they're just phenomenal and we're going to take a bet. But in general, we're staying away from Gen AI and, all sorts of, AI plays. I probably get 5 or 6 in my inbox every day, and it's just so hard to tell what's real and what's not. And so we're tending to stick more into that hard tech, physical something, rather than some type of AI infrastructure play or,
Yeah, that's a really cool perspective to look at it. I think there's so much great insights from this talk. Also, like investors are getting real insights on how to deal with various situations. So I think now, like, what would be your advice to startups, and maybe what are the most like common red flags that you see in your inbox?
let's see if I can get as actionable as possible. I think the number one issue I see with like founders pitching their company is that they're not telling a story. So, like for thousands of years, right, we've been telling stories. Stories are like the cornerstone of how we form beliefs. It's the way we communicate information. It's how we communicate meaning without actually being like, hey, pay attention to this, right? Tell me a story. It's like what do kids want when they go to bed? Stories. Why? Because they're engaging, entertaining, and informative, and they're human, right? And
Yeah,
it sounds so simple, but I'm like being dead serious, like we need to tell better stories. And
yeah,
the story that you want to tell is basically the world when your company exists in it. What does the world look like when your business exists in the world? What does that world look like? Who does it help? How does it help? What does it change? What's the new paradigm? Right? And that gets me excited. Investing is emotional. I see 20, 30 pitches a day. I got it in my inbox, right? And I'm going through and I'm thinking, man, like this is boring, this is boring, this is boring, this is boring. Nothing grabs me, right?
yeah,
Grab my attention, right? And the way that we do that is you tell me a story about what the future looks like, what the world looks like with you in it, with your business in it. And so many people overlook it. They think it's about problem solution, market opportunity, go to market, and it's this like plain old vanilla boring situation. And look, there's exceptions to every rule. Sometimes I see a pitch and it's like boring and vanilla and amazing, right? Because the technology is so profound, right? But chances are,
yeah,
without telling a good story, it's just going to be, clear from my inbox, right? It's like
yeah,
that's how you get my attention. I
yeah,
want to get excited. I want to feel like I believe in the world that you believe in, right? And
yeah,
at the end of the day, like my job is just to help money flow to where it wants to be, right? And the way that I help it flow is when I hear a good story and it resonates with me and I feel like, wow, yeah, I want to live in that world. Then it makes it a lot easier for the investment to happen. And it's emotional, right? I want to like it. I want to like the founder and I want to feel good about it. And I think it's overlooked. I think a lot of people spend so much time in the nuts and bolts and don't think about telling a good story. And at the end of the day, like stories build relationships, stories build
yeah,
trust. Everything is built on relationships and trust. So
yeah.
yeah, just say tell a good story.
Yeah, that's really cool advice. I think we are running out of time, but I think like that's really cool for all the founders out there. There's a lot of ways like now founders can be able to tell stories through like social media. They can learn how to do good storytelling for what they're building. Also, there's a lot of information around this. So what's like one parting shot to founders who are fundraising at the moment and are maybe in emerging?
Yeah, I guess one last piece of guidance would be, every no that you get is one step closer to yes. I think I pitched 80 different firms before we got our first yes. And, you just have to find the people that are going to invest in you, right? And that just takes time and it takes iteration and it takes patience and it takes courage and it takes grit. And at the end of the day, like, statistically speaking, the more no's you get, the closer you are to yes. And so I would
Yeah,
just say, like, just push through it. It's a slog. Learning how to do this is an art, right? Learning how to do it
yeah,
well is takes time, takes effort, takes mistakes, takes failure, and perseverance is the name of the game. So
yeah,
iterate. Don't be afraid to change your story, change your pitch, and yeah, just practice, 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 and yeah, at the very least, you're gonna learn a lot about yourself, learn a lot about the business, and make great connection.
yeah. So, that's it for this session. I've loved the insights from this session. They were really eye-opening. You can stay in touch with us through our email, our social media, and follow us for this series. There's been really interesting guests that will be coming up. So that's it for today. See you next time. Bye. So yeah.